Wait, what if one bank shorted more silver than the world can mine in 5 years, and a billionaire analyst just gave it 90 days before it collapses? JPMorgan's 4.5 billion ounce short is the largest commodity bet in history, and it's fracturing. I compiled the forensic proof: vault drains, sealed settlements, Eastern panic buying. Subscribe now, smash like to support the channel, and don't skip, because by the end, you'll know exactly what $500 silver means for your money. JPMorgan holds a short position on 4.5 billion ounces of silver. To understand the scale, global mines produce roughly 800 million ounces yearly. This bank has bet against more than 5 years of worldwide production. How did this happen? The accumulation began after the 2008 crisis, when JPMorgan absorbed Bear Stearns, inheriting their massive derivatives book. Instead of unwinding it, they expanded. By 2020, whistleblowers and analysts exposed the pattern. The position grew in silence, while price suppression became routine. Regulators knew. The Commodity Futures Trading Commission received thousands of complaints. Yet enforcement remained weak, fines minimal compared to profits. History offers a warning. In 1980, the Hunt brothers controlled just 200 million ounces before the market imploded. JPMorgan's exposure is 22 times larger. The anomaly isn't the size alone, it's that this concentration exists in plain sight. The question lingers: why hasn't forced liquidation begun, and what happens when it does? In 2020, JPMorgan paid $920 million to settle spoofing charges. The Department of Justice called it the largest penalty ever for market manipulation. But here's what mattered more: no executives went to prison. The pattern stretches back further. In 2014, investigations into precious metals fixing emerged across London and New York. Banks settled quietly. Documents were sealed. The public learned little. Think of it like catching a thief, but only taking back part of the stolen money, then letting them continue working at the same store. The settlements confirm manipulation happened for at least a decade. Traders placed fake orders to move silver prices. Internal messages showed coordination. Yet the short position remained untouched. This is the red flag. Fines punish past behavior, but they don't force position unwinding. JPMorgan paid and kept trading. The open question troubles investigators. If manipulation was proven and admitted, why does the massive short still exist today? Willem Middelkoop is not a social media speculator. He manages billions in commodity funds and advises central banks. When he predicts $500 silver within 90 days, markets listen. His thesis is simple: silver remains the most undervalued monetary metal in history. The gold-to-silver ratio sits near 80-1. Historically, this ratio averaged 15-1 for centuries. The gap signals extreme mispricing. Middelkoop points to supply destruction. Mining investment collapsed after 2011. New discoveries dried up. Meanwhile, industrial demand from solar panels and electronics keeps climbing. Imagine a spring pressed down for decades. Eventually, the pressure finds release. His 90-day window connects to delivery cycles on COMEX. Large contracts come due quarterly. If physical demand overwhelms paper supply during settlement, the squeeze begins. Critics call his target extreme. But in 1980, silver jumped from $6 to $50 in weeks. Percentage-wise, Middelkoop's forecast follows similar mechanics. The lingering question: is 90 days a prediction or a warning? 3 catalysts could ignite the squeeze within 90 days. Each operates independently, but together they create compounding pressure. First, COMEX delivery stress. March and June contracts force physical settlement. When buyers demand actual metal instead of cash, paper promises collapse. Recent months show standing for delivery rates climbing unusually high. Second, Eastern accumulation accelerates. China and India import record silver volumes. Russian sanctions pushed central banks toward hard assets. Metal flows east and doesn't return. Third, industrial panic buying. Manufacturers need silver for solar panels, EVs, and semiconductors. Supply chain fears trigger hoarding behavior. Picture 3 rivers converging into one narrow channel. The flood becomes unavoidable. In 1979, similar catalysts aligned before silver exploded. Inflation fears, physical hoarding, and short covering collided within months. The anomaly today: warehouse inventories hit multi-decade lows precisely when these pressures mount. Coincidence seems unlikely. The unanswered question remains: which trigger fires first, and does JPMorgan see it coming? COMEX registered silver inventory tells a disturbing story. In 2021, warehouses held 120 million ounces available for delivery. Today, that number sits below 30 million. Metal is vanishing faster than it arrives. Registered means verified and ready for contract settlement. When this category drains, physical delivery becomes difficult. Buyers receive IOUs or cash settlements instead of actual silver. The pattern mirrors 2011 before silver spiked to $50. Back then, inventory drops preceded the price explosion by months. Smart money saw the signal. Think of it like a gas station showing full prices but running dry underground. The pumps work until suddenly they don't. Meanwhile, SLV, the largest silver ETF, reports custodian transfers to JPMorgan vaults. Metal moves, but transparency disappears. Audits remain infrequent and incomplete. The red flag screams loudly. Demand rises while visible supply shrinks. Someone is accumulating ahead of the storm. Who holds the real metal and who holds only paper? When JPMorgan covers 4.5 billion ounces, the buying pressure breaks markets. Here's the cascade sequence. First, they must buy contracts on COMEX. Prices spike immediately. Other shorts panic and join the buying. The feedback loop accelerates. Next, bullion banks holding similar positions face margin calls. Forced liquidation spreads across London and Shanghai exchanges. ETFs scramble for physical backing. It's like yanking one bottom card from a house of cards. Everything above shifts violently. In 1980, the Hunt brothers' forced liquidation pushed silver from $50 to $11 within days, but they controlled far less metal. JPMorgan's unwind would dwarf that chaos. The anomaly emerges in derivatives markets. Open interest suggests multiple banks share overlapping exposure. One failure triggers others. Central banks historically intervene during such events. The 2008 playbook involved bailouts and rule changes. Will silver receive similar protection? The haunting unknown. Can any entity absorb this position without systemic collapse? All evidence points toward monetary system fracture. JPMorgan's silver position represents more than one bank's problem. It is a structural weakness threatening global markets. When unwinding begins, currencies backed by nothing face comparison to physical metal. Silver at $500 means the dollar lost 90% purchasing power against real money. Central banks cannot print silver. The inheritance pattern looks predictable. Retail investors holding physical benefit massively. Paper holders discover counterparty risk the hard way. Banks require taxpayer bailouts again. Consider this parallel. In 1933, Roosevelt confiscated gold after banks couldn't deliver. History suggests similar emergency measures for silver. Executive orders, trading halts, forced settlements at artificial prices, all remain possible. The forensic trail reveals coordinated suppression for decades. Now physics demands reversion. Like water finding its level after a dam breaks, price discovery returns violently. The final question haunts everyone watching. Who knew this was coming and who gets caught unprepared when 90 days expire? The patterns are undeniable. JPMorgan's impossible short position, draining inventories, Eastern accumulation, and Middelkoop's timeline all converge on the same point. This isn't random market movement. It's systematic unwinding of decades of suppression. History teaches that extreme dislocations correct suddenly, not gradually. The Hunt brothers proved it in 1980. Lehman proved it in 2008. When leverage meets reality, the adjustment shocks everyone except those who read the forensic signals. Silver at $500 sounds impossible until you calculate what 4.5 billion ounces of forced buying does to a market with 30 million ounces available. The math is brutal. The timeline is closing. Those holding physical metal understand what's coming. Those holding promises will learn the difference. In 90 days, we'll know if Middelkoop called the exact moment when the greatest commodity short in history finally exploded. The evidence is complete. The countdown has begun.